They're usually sold in increments, small denominations of usually $100,000 or multiples of $100,000. Oftentimes, bonds are sold with the intention to convert them into common stock. So, individuals or investors will purchase bonds, sometimes in corporations, with the ability at a later point to take that investment they've already put into the business and allow them to be a common stockholder at a later point. But as long as the bond has been issued, it's an interest-bearing bond, which means they're earning money on their investment. The companies who've received the money will have to pay that interest at a later time when they actually pay off the loan, essentially. But more importantly, investors are getting an opportunity to provide some capital in their businesses and then be able to help the company continue to move on. So important things, they will get a bond certificate. The investor will give the information as far as how many shares or the issuance of the bonds, the face value of the bond, meaning the dollar amount that they have actually borrowed from the individual investors, when that bond will mature, the date in which they anticipate getting their payment back, or the option to maybe convert into common stock, and then also an interest rate. There's also contractual interest oftentimes determines what type of cash or interest will be paid, meaning how often, if it's annually, quarterly, etc. Corporations only record bond transactions when they issue the bond or they retire it. When they retire, that means they've actually called the bonds and they're going to pay the investors back the amount that they have borrowed plus any interest that's accrued up to that point. And they also would record transactions when bondholders convert bonds into common stock. So if there was an option for investors that purchase bonds to get common stock as a form of payment, there would be an additional journal entry to show that the liability has been removed and they are now a stockholder in the business. It's important to recognize too that bonds can be issued with face value, which means they're worth exactly what the certificate says they're worth, but they can also be issued at a lower or higher price than what the face value is. So below the face value would mean that they were issued at a discount, so less than 100%, or maybe at a higher price than the face value at a premium, meaning over 100%. It's important to recognize too that bonds are always identified as a percentage of the face value. So here's an example. If they issued 100 5-year bonds at 10% interest, what would the entry look like? So when they sold the bonds to the individual investors, they were receiving 100 bonds at $1,000 each. So there were 100 different individual investors or increments of $100 available at $1,000 each for a total of $100,000 of additional revenue into the business. So their cash is going to go up by the $100,000. At the same time, they take on a new liability for the bonds payable, the amount that they're going to need to pay back to those investors in the 5-year period, but recognizing not only would they have to pay this $100,000 back, but the additional 10% in interest that they have promised these individual investors. So to prepare the interest that would accrue at the end of the year, they're taking the $100,000 times the 10% interest, and of course it was for a full year, so that's 12 out of 12 months. So the interest for 1 year for this bond would be $10,000.